Hello, my friends. Today is June 14th, and this is my June FOMC meeting debrief. Now, before we get into what happened at the Fed meeting, let's talk about where we are. So, just to level set a bit, so we had a rate hike at the last meeting, and between then and now, data was, reasonably positive. We had unemployment beating to the upside, and to be clear, it's been beating expectations for quite some time now. We also had an inflation print, where the headline inflation is coming down, the core inflation, which the Fed cares about much more, remains pretty elevated. So during the intermeeting period, we had Governor Waller come out and say that, he doesn't think that we're done hiking, but he is open to skipping this meeting. So from his perspective, we would either hike in June or we could hike in July, the skip. After markets heard him, markets were pricing in increasingly aggressive potential of a hike in June. But after he spoke, future Vice Chair Jefferson came and he was all in on the skip. So he very pointedly said that he's on team skip. Okay, so once he said that, the odds of a June hike went down significantly and people were placing bets on a July hike. So that's where we get to today. Today, it was widely expected that the Fed would skip and that they would reveal a more hawkish dot plot. So all in all, it would be a hawkish skip. And from my perspective, they delivered that very well. So, okay, first off, obviously, they did not hike. Secondly, the hawkish part of this skip comes from their dot plot projections. So every quarter, the Fed produces a set of projections where each FOMC member notes down where they think inflation growth and the overnight will be at the end of this year, the next year, and the following year. I expected that the dot plot to show a higher Fed funds rate for the end of this year, but what was shown was more hawkish than my expectations. So in March, the dot plot was showing that the Fed expected the federal funds rate, a median expectation of about 5.1% at the end of this year. Now, today, the dot plot shows the expectation is 5.6% at the end of this year. So the Fed now is pricing in is projecting, based on their current projections, let's say 2 more hikes this year. And to be perfectly clear, the Fed's projections, are not that great. But it is a way of telling you what they're thinking about right now. So today they told you that they're skipping today, but they are thinking about hiking 2 more times this year, and that is more than was projected in March. So in my view, that's about as hawkish as they could be. The second part that I found this more hawkish than expected is that the individual dot plots, which are plotted, show that there's widespread agreement on the FOMC that we should hike 2 more times this year. So right now, there's kind of a discussion, a fight between the doves and the hawks on the FOMC. It was easy to get everyone on the same page to hike from 0 to 500 basis points. But as we go further in the tightening cycle, there's a lot more disagreements. The dovish people, they will want to be more cautious, and the hawkish people, they would point towards entrenched inflation and want to hike a bit more. So what surprised me is that despite this apparent disagreement, there's widespread support on the FOMC to hike twice this year. So again, I read that as pretty hawkish. Now this response though is perfectly in line with their broader forecasts. So in March, their forecasts were that we would hike to 5%, and then GDP would slow down, inflation would come down, and unemployment would tick up. Well, now in June, none of those forecasts are happening. In fact, GDP has been stronger than expected. The Atlanta Fed Now GDP data, which is very noisy and will be revised, but so far is pointing towards GDP growth this quarter of about 2%, which is above trend. And as you know, unemployment rate is still around multi-decade lows, and we did have a pretty strong jobs report last month. And inflation, well, the Fed's favorite measure of inflation, core PCE, has basically been stuck between 4 and 5% for the past several months. So all in all, things are not evolving according to the Fed's expectations in March. Now during the meeting, there's a lot of questions about, Chair Powell, why don't you just hike now? Why don't you just, why skip a meeting if you think that you need to do more? So Chair Powell gave a really good refresher on how he's thinking about this. Now, this is helpful for us to understand because it's helpful for us to be able to predict how the Fed will act in the future. So in response to the question why the Fed isn't just hiking to this month again, since they thought that they would hike again later, twice this year, Chair Powell noted that, well, of course, we don't have to hurry right now, because when thinking about rate hikes, there are three things he keeps in mind. First is the pace of hikes. Second is how high he wants to hike. And lastly is how long he's going to hold rates where they are. So last year, Fed was really, really behind. Inflation was really high. So they hiked rates very aggressively. They did a bunch of 75 basis points hikes. Quickly got to around 5%. And now that they're closer to where they want to be, the Fed feels like they have time to just kind of, adjust rates up a little bit at their leisure, because they're really close to where they want to be. They're just not exactly clear just how much further, so they can take their time. And the last thing that Chair Powell noted was how long he wants to hold rates around here. And as the Fed has been saying over and over again, they want to hold rates higher for longer, so longer than what the market has been expecting. Now, the market has come a long ways towards the Fed's view. Right now, they're not fully pricing in 2 more rate hikes by the end of the year, but over the past couple years, the market has eventually come towards the Fed. So that could happen in the coming months, especially as data seems to surprise to the upside. Now, if you remember our last discussion, the problem facing the Fed is something that is seen throughout the world. You have Australia, Canada, UK, the EU, everyone is dealing with stickier than expected inflation, and everyone is hiking aggressively. So I suspect that the US is not going to be different. They are going to have to resume hiking after this pause, because inflation is going to be more stubborn than expected, and economic growth is actually going to be more positive than expected. Now, something else that kind of stood out to me was it seemed like Chair Powell was almost calling the bottom at the housing markets, noting that it's been rebounding. I thought that was pretty interesting.
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates, and we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think.
So all in all, I think this was a meeting just in line with expectations, nothing super special. One other thing that I would note is that a lot of concern has been discussed about the potential effects of the March banking panic. So there was a lot of concern from Fed members that, we have this thing happening in the banking sector, and maybe that might reduce the willingness of banks to make loans. They might tighten lending standards. And that was part of the reason why the Fed hiked 25 basis points last meeting instead of 50. Now, this time around, reporters were repeatedly asking the Fed, hey, what are you hearing from the data? Are banks tightening their credit standards? Is there less lending and so forth? And Chair Powell, most interestingly, just kind of dodged that all the time, even though the Fed has really good data on through their network of contacts that they speak with every day, as well as through their regulatory powers, where they can simply just ask people, what are you seeing? He dodged that. So he said that it's early. He wants to get more data, and I guess that's understandable. But that was a big reason behind having slower rate hikes earlier on, and now he's not mentioning it so much this time around. I will note though that people who have discussed this, I believe President Kashkari and also President Logan have noted that this is a concern for them, but they actually haven't seen banks pull back so much in lending due to concerns from the March bank panic. To be clear, overall, banks have been slowing down lending for the past several months as rates have gone up and the economic cycle is slowing. One tell, though, is that every individual FOMC member knows what's happening in their district, and also marks down their forecast for Fed funds rate at the end of the year on the dot plot. And if they're all marking down, well, not all of them, but most of them are marking down 2 more rate hikes this year, then it seems to me that in their judgment, the slowing down of credit creation from the banking sector hasn't been as severe as expected, and may not be as big a crimp as it could be, as was feared. So I think that's some indirect positive information that I took from this discussion. Okay, so that's all I prepared for today. Be back this weekend. It might be a little bit late, so I have to speak at a conference this weekend, but speak later about the weekly markets review. All right, talk to you guys later.